to you. Just lagging a second.
Yep, there we go.
Perfect.
Okay, I won't worry about starting again for those who've missed the start. But yeah, in terms of the relationship between the two firms, we're basically very, very aligned in terms of our approach, in terms of the customer-centric approach. We both take a long-term view, so there's definitely no hard sells, and it's all about kind of creating the right solutions for our clients. Being kind of neighbours just up the road in North Sydney, it makes logical sense for us to really kind of double down on in terms of that relationship. And what we thought today would be very, very useful was there've been a number of material changes in relation to insurance that will kind of have some potential major implications for not only our clients, but also ourselves. So James and Vincent today have graciously agreed to kind of give us a bit of a presentation about what those changes are and how it can potentially impact us, and are able to help out both us as kind of individuals and also clients of the firm. I will say I recently switched across all of my personal insurances across to the team from Stanford Brown, and the experience was very, very easy, and they got me some very, very good kind of outcomes from that.
Perfect. Thanks, Matt. I might kick off. I'm just going to present the screen. Give me 1 second. I'll bring that up. Now, a lot of you may not actually know Stanford Brown very well, so I thought I'll just going to spend 2 seconds, hand over to Vincent just to introduce who we are, and then I'll dive into that insurance and what do those changes look like for you and your clients as well. Before we get started, quick disclaimer, obviously everything today is general in nature. There's no personal advice that's been taken, but if you do need some advice, then please do reach out and we can provide that to you on a one-on-one basis. So like I said, today, just a very quick agenda to run through. Vincent will give an intro to who we are. I'm going to give you a bit of background about why APRA has actually intervened into the insurance market, provide a bit of an overview of what their guidelines were, and then talk through the key changes that the insurers have actually made in that space. But most importantly, what are the key considerations for you and your clients when you are meeting with them to address this in the future as well. So Vincent, I'll hand over to you to do a quick intro.
Yes, certainly. Thanks a million, James. And I guess firstly, thank you to Matt and all the team for the opportunity just to speak this afternoon, and for your kind words. Stanford Brown is quite a significant size as financial planning firms go. We've got approximately 45 staff based here in North Sydney, and we very much are focused towards the holistic end of the advice curve. So particularly when firms get to our level of scale, they often can become wholesale only, which essentially means they become only focused on money management. We've got a deliberate focus within our firm that we want to look much broader than that. So that encompasses basically the client's entire world. We'll be looking at obviously investment related matters, but also things such as insurance, understanding their broader balance sheet and structures, and trying to work very closely with their third party professionals. So that's obviously their trusted accountant, their lawyers, to make sure that everything's working in sync in terms of how those structures are put in place. Are we investing via the right structures? Is the money flowing in the right direction and recorded appropriately? And does that work in harmony with what their estate planning is? Because obviously you pick it up and sometimes it's absolutely, each piece of work is excellent on its own, but they're not working necessarily in harmony. We work with probably about 800 family groups, predominantly sort of based, obviously New South Wales based, but also across some in Victoria and some in Queensland, and a few scattered elsewhere. Our primary client base is in that executive and professional sphere. We've got a lot of focus on those busy executives, but also particularly towards business owners and entrepreneurs, and then retirees. And that almost becomes the work that we do with, if you want to consider wealthy family groups. So we get heavily involved now in things such as intergenerational wealth, and particularly families considering not only what they want to do for their children, but their grandchildren, and how much do you want to pass on and when. And it's a bit of a balancing act, one, to help them get started in life, but secondly, not to pass on so much to sort of demotivate. So that becomes a big part of the work that we do, and we actually have a couple of white papers in that space if anyone's interested. Some of the we also then in our business, and James heads this up, have a benefits advisory aspect to our firm, and that helps provide advice to what we describe as progressive companies or employers around their broader benefits offering for their employees. So that will be everything from superannuation through to insurance, but also things like private health insurance and even more micro aspects of financial wellness, particularly, but also across to other areas such as mental and physical wellness. So obviously that's a very topical area right now, and James sort of leads the team in that space. And we've got some marquee clients across both the technology sphere and some of the names that you see in front of you, but also particularly in finance and even other progressive companies such as Visi that look after thousands of staff. We do quite a bit of work with a number of not-for-profit organizations as well, so that might be across a few different areas. One, they engage us to invest and manage their residual capital and help them understand, what their mandates and things are for that. And also we like to get involved in pro bono work. We think that's a big part of what we do. So we work, for example, one is with the Cancer Council for people that unfortunately have a negative diagnosis and don't always necessarily have their finances prepared for that. Well, we do work with the Cancer Council and families that they refer to us to try and do what we can to make the most of the situation that they're working into. And we also offer that same pro bono service to our clients. So I've sort of given you the broad overview there of the business around that sort of wealth management, that integration with third-party providers via our network. The wealth protection piece, which James will now talk to in much more detail around the insurance and the benefits advisory sphere. The last two comments I'll make on our firm, just to give you a full picture, is one, we are owned by 9 partners or shareholders in the firm, so we don't have any institutional involvement, which is probably quite rare for a firm of our scale in the industry. And the second element is we very much believe in the specialist advisor role. So kind of like the tax professional versus the structuring professional, or in your industry, you'll have people will have a particular focus or a few focuses. We certainly don't feel that the advisor that knows most about investments is the same person that knows most about insurance, and particularly in areas like insurance where it's become incredibly technical. So that's my way of saying, once we get down into the weeds of insurance, I will have limited value to add on this call. James will be doing most of the talking, but I will hand over to him to take you through it.
Perfect. Thank you, Vincent. So to give you a bit of background about what has happened, or why has APRA really got involved in the insurance space, there's a bit of research here around that was completed by KPMG alongside the FSC. And this was done comparing claims from 2014 through to 2018. And they found that income protection claims doubled during that period. So the amount they're paying out per annum to $4.9 billion per year. And the length of the claims were increasing as well. And they increased by about 36%. And over the last 5 years, the industry as a whole on income protection benefits have lost $3.4 billion. Now, APRA felt the need to intervene because insurers were provided the mandate to obviously provide a equitable and future-facing product for their clients, but they had the bias of the fear of first to move. So the first insurer that would come out and offer a product that might have lesser terms or not as favourable terms to the clients would actually lose market share. So APRA felt the need that they should intervene using a few levers that they have available to them. Again, you can see here, just on that diagram, this is the year-on-year losses against the 4 different product types. Now, I apologize, I know it's a bit blurry there, but I had to make a copy from another presentation just to show this slide. But you can see there that the dark blue is the individual disability income insurance. And there's significant losses over the last 3 years. Now, that trend has increased into 2021 as well. So the insurers really had no choice but to make some changes to try and tackle the losses that we're experiencing in this space. Like I said, the insurers were very reluctant to be the first to move. They didn't want to lose market share. It was a very competitive market in Australia, but also there was a fear of losing the reinsurers as well. So it's important to note that the contracts we had in Australia were world leading in regards to their terms, and not seen in any other mature market around the world. And as a result, a lot of the reinsurers were getting very nervous about the losses and the experiences that were occurring in Australia. And there's a very real risk that they would actually withdraw from our market as a result as well. So what did APRA come out and say? Initially, there was three things. First of all, they introduced a Pillar 2 capital charge. And the purpose of that is that insurers will be individually rated for their income protection exposure, and there would be a capital charge imposed at an individual insurer level, which is relative to the risk that they have for their portfolio. So in other words, if an insurer did not make changes, they would have much higher capital reserve requirements than an insurer who did make changes, and therefore could be quite crippled from a cash flow perspective if they didn't trigger these changes. Secondly, APRA immediately, and I'll get into this in a little bit more detail in a minute, but they said that no longer can insurers provide agreed benefit contracts, and I'll explain what that means. And lastly, they really want the insurers to start talking to each other, especially around claims experience. So all the insurers were working very much in silos when they were putting together their products and their rates, etc. And that has really led us to this experience where significant losses and inadequate allowance made for possible claims because of the products that these insurers have been put in place. From October 2021, there was 4 key areas that APRA gave direction in, and I'll go into more detail at a product level in a second. First of all, when a person goes on claim, the claim must be assessed based on their income at time of claim. Okay, and APRA has mandated that that's their 12-month at time of claim. The replacement ratios, now pre-changes with all the different benefits, terms and conditions, some claimants were receiving up to 120% of their insurable income at the time of claim, especially for the first 6 to 12 months. As a result, they've put in caps or guidance that these percentages should not increase more than 70% ongoing, but 90% in the first 6 months of claim. From a longer term perspective, APRA wanted to see that there was right risks and measures put in place to really manage the long-term exposure that they had to these income protection claims. And lastly, this last piece has not come into effect, and I'll talk about it more in a second, but they're looking to put a 5-year term, a renewable term on these contracts. So let's talk through some of what we think are the key changes from a product perspective. And we're going to show each from what it was previously to what it is now under new insurance products that have gone live on 1 October. One of the key changes, like I mentioned, was incomes will be assessed at the time of claim. Pre-March 2020, we had what was called agreed benefit contracts. An agreed benefit contract meant at the time of application, you proved to the insurer your income level. And even if your income fluctuated or changed or reduced at the time of claim, the insurer agreed to pay you that benefit amount. Post-March 2020, APRA said you're no longer allowed to sell agreed benefit contracts. And as a result, everyone must provide indemnity contracts. Now, the contracts that were available between March 2020 and 1 October this year were still quite favourable in that they averaged your income over 3 years at time of claim, or 2 to 3 years, depending on the insurance product that you had. So it made some protection for your self-employed or people who experience fluctuating incomes for various reasons. Just in case, I mean, COVID's a very perfect example. Let's say in the last 12 months, many people's incomes fluctuated greatly as a result. This trigger allowed that income to be averaged over a 3-year period to allow for these kind of fluctuations. From 1 October, the new products are on indemnity, but they can only assess your income over a 12-month period. So it's quite a reduction in benefit type. for new insurance products. There are one or two out there that do have some leniency up to 24 months for some kinds of self-employed benefits or sole traders, but the general rule is that on time of claim, everyone will be assessed at their income for the 12 months prior. Another key change is the replacement ratio. Previously, it was pretty standard across the entire industry that income protection benefits, the maximum sum insured you could insure for was 75% of your income. And that was plus super as well. So 75% of your income plus your super entitlements could be paid out to you as a disability benefit. From 1 October, APRA mandated that these couldn't exceed 70%. And we've found that it's varied greatly across a number of the insurers, between 60 to 70% being provided. And some insurers actually reduce the percentage after a 24-month period as well. This is creating a lot of confusion around product choice for clients. And you'll see there's other variances that we go through as well, is trying to find the product that suits the majority of the client's needs, while taking into account that multiple insurers has very, very different types of benefits available as well.
I think Matt has a question there, James.
Apologies, Matt. Yep.
No, it's all good. I forgot to ask you at the start. Are you fine, James, if any of the guys have any questions to
100%.
kind of ask? Yep.
Yeah.
Just fire them away.
Fire them away. If you've got a question, it means someone else is probably thinking the same thing. So
Perfect.
definitely. So replacement ratios is a very big reduction that's been applied. The last thing to note there also is that super contributions now must be paid into super. So they used to be able to be paid out to you directly. They must go into superannuation now going forward. Now, the amount of coverage you can get has changed greatly as well. So pre-1 October, it was fairly consistent across insurers for large incomed clients that you could insure 75% of the first 320,000 income, 50% of the next 240, and 25% of the balance. And they were usually up to maximums of $30,000 or $60,000, depending on the insurer. New products, there is no consistency between the insurers, and it varies significantly. So we did a calculation just based on a 30,000 per month benefit to see what income level you would need across multiple insurers to actually hit that maximum 30,000 sum insured. One insurer, you needed an income of 700,000, another was 840, and another insurer, you needed $1.3 million to actually obtain that $30,000 benefit. So again, it's not, it's quite complex between the various insurers to make, if your goal is to make sure you get the maximum sum insured on a claim, it's quite complex to work out who's going to give you the highest replacement ratio, as well as who's going to, from an income perspective, provide you the highest benefit as well. Benefit periods changed a little bit. So pre 1 October, you could get a 2-year, 5-year, age 65 or age 70 benefit period. So a benefit period is for how long your disability benefits will be paid if you can't go back to work. Yeah. Under 1 October changes, to age 70 now has been removed. There's only one insurer, I think, out there who still is providing that benefit and likely will remove that from their market as well. So that really now is capped at that 2-year, 5-year and age 65 coverage. But I find most people did have that age 65 coverage in place. The biggest change, and this is the one that's probably of most concerning, is products pre-1 October, the definition of disablements, you were always assessed against unable to do your occupation. So it's me, James, unable to be a financial advisor specialising in insurance. If I can't do the important duties of that occupation, I would get paid my benefit. Under new contracts, and again, it's varying between insurer to insurer, so there's a lot of complexity here. You do have own occupation for the first 2 years. That's very consistent across the market. But from 2 years, the majority of insurers are actually switching to an any occupation. So it's not me, James, that I can't be an insurance advisor. It's James, what are you suitably qualified for? And can you do something else?
Might you put a couple of examples to that, James, to just put a bit of colour around it?
Definitely. So a couple of examples might be, let's say a surgeon. So let's say someone who does surgery on a regular basis, 3 or 4 days of their work would be being in an operating theatre, and dexterity in their hands would be very important. Now, if a surgeon was to actually damage their hands, they wouldn't be able to operate as a result, but they could teach, they could do clinical appointments, or they could change their speciality to an area where that dexterity was not as important as well. So very much a big change, especially for those really niche or important occupations. Accountants would be very similar. So let's say that you had something that's affected your mental acuity. I'll give you a live example. I've got a client who unfortunately had a brain tumor. That brain tumor was successfully treated, but as a result, he got what was brain fog. Couldn't make quick, decisive decisions, and he was actually a CFO in a company. As a result of that brain fog, he couldn't make reliable, quick financial decisions for the large company, and as a result could no longer work in that occupation. But there's no reason why he couldn't take on some other kind of financial role within the business. Granted, a lesser income or responsibility, but he would be capable to work in another occupation as a result. Last point on this one, there are 1 or 2 insurers that are saying that if you are working towards an agreed return to work or rehabilitation plan, that they will continue the own occupation definition past 2 years. And that's an important thing. There's only 2 in the market that are offering that. One of them is PPS Mutual, which is a insurer that specializes in just insuring accountants, lawyers, doctors, highly qualified people. Again, that product actually is not widely available in the market, only through select partners and advisors, which we've got access to. Something to definitely keep in consideration when choosing products post 1 October for the professional services.
James, just on that brain fog example you had.
Yes.
The person's gone back to work. Does that mean they don't get any cover, or they just get cover from the difference between their original wage and what they're currently getting?
Yeah, that's a very good question. So one of I was quite limiting on the points that I put in this presentation because there's so many things that have changed. I was trying to go for the more pivotal. The contracts from 1 October, the majority of them have what's called a capability and clause in them, and they didn't have them previously. And it basically means that you, Dean, if you are capable to do your job or capable to do another job that you're suitably qualified for, the insurer can reduce your benefits even if you're not working. Yeah. The contracts previously didn't have that clause in there. Yeah. So if you couldn't do your role as an accountant or specialist, but you were capable to do a lesser role, the insurer could reduce the percentage of benefit being paid accordingly. And that's in their calculation, really up to their discretion to make.
Okay, thanks.
Yeah. Another big difference was that, and this is really for self-employed people where this is very important, it was the actual definition of disablement changed. So on old products, or majority of old products, I should say, they had what's called a 3-tiered definition. And that assesses you as being unable to work if you met one of those conditions. And the first one is unable to work one important duty of your occupation, unable to work more than 20% in hours, and unable to generate at least 20% of income. Yeah. So as a self-employed person, I could come into the office 1 day a week, make sure the business is still running, sign the checks, make sure people are paid if I could do so, but still get paid my full benefit. I wouldn't be penalised for doing so. From 1 October, APRA has mandated that that's no longer allowed. You need to be unable to perform, and it says the important duties of their occupation. So it's not just one pivotal duty, it's unable to do what are important duties across your occupation. So that could be, I've used accounting as an example, that could be, logical thinking. It could be being able to sit for long periods of time in meetings. It could be able to actually converse and communicate clearly. But it wouldn't be things like traveling to and from or going to appointments, etc. as well. The waiting periods, another important change here is that day one partial disability has changed, and let me talk you through that. Income protection policies are designed to give you a benefit if you can't work. And there is a fault in the new products that if you have an illness that starts off very slow but progresses over time, you need to be off work for a period of time to be able to get paid those benefits. And I use a couple examples here. So if you were diagnosed with something like MS or arthritis or dementia, they sound like, especially dementia sounds like older person illness, but I've got multiple clients in their 40s and 50s with early onset dementia claiming under their benefits. Now, day one, they might not be able to work 100% of their occupation, but they might be working 80% or 70% until they're off work for the waiting period. And some insurers require you to be off for 14 consecutive days. Some people require 14 out of 19 consecutive days. There's no consistency across any of the insurance products. You won't be eligible to claim underneath those products. So it's another important just to flag of the change in that instance. Now that one again was very important for your professional services as well. So your doctors, etc. Because what could affect them to be able to do long-term, long days of surgery, etc., may not affect me being in the office doing office work as a result. Okay, and then lastly, the last point I wanted to touch on is the claim, when the actual claim ceases. So under the old products, you were eligible to receive your benefit until you return to full-time work. And like I mentioned before, the new products have that capability clause in there, because as soon as you're capable to return to work, the insurer, under the letter of the contracts, can cease your payments. Now, in reality, it's very unlikely they would just stop it the day after they make that determination and would support you back to work. But they do have the capability to switch those payments off once you're able to work. The other thing to note here is that there's an hours test that now is applied to the majority of these new policies. And as soon as you do hit those hours tests, you are considered as being back to work full time. Now, I don't know about you guys, but the last time I worked a 38-hour week, it was quite a long time, and I would consider that probably part-time sometimes. It affects really self-employed people. It affects really highly functioning professionals, doctors, accountants, etc., that may work more than a 40-hour week. Even if your income doesn't return to pre-disability levels, once you are working or capable to work those hours, you are considered as being back to work full time, and they will stop paying your benefits at that time. And the very last point, and this is another change that isn't coming yet, but it's proposed to come out in 2022. APRA put a delay on this one because the insurers were actually struggling to implement the recommendation, is that current insurance products are all what's called guaranteed renewable. As long as you pay your premium, you've got that contract in place and it can't be taken away from you. Yeah. Under new products or income protection products from 2022, they'll have what's called a 5-yearly renewable term. What that means is after 5 years, the insurer would then come back to you and you would need to redisclose your income and your occupation and any other pastimes for them to reassess whether they would actually provide you that coverage again for the next 5 years. So it's no longer you'll be able to purchase a policy that is non-negotiable for lifetime. It now needs to be reassessed every 5 years. I'm not confident that this one will come through because the insurers are definitely pushing back. They can't see how they can implement that in a cost-effective way, but it is tabled to be implemented next year, and I'll give you an update if and or when that comes through as well.
So are you saying there that the old policies would cancel?
No, so that's an important point. Sorry, I should have covered you off. Anything pre-October, you've got a contract with that insurer. So as long as you're paying your premiums, it can't be altered or changed. Yeah.
None of these changes take effect to the old policies?
No, they don't get rolled back. It's only for new contracts from 1 October. And that's the complexity. and I'll talk to, it's actually a good lead in because I want to talk to about what are the key considerations for your clients and yourselves as well, is really around our default position is the existing contracts that were available pre-1 October are superior. Yeah. And as long as you can afford the premium and you're happy to pay those premiums, our recommendation will always be to maintain those policies. The problem is, though, the premium rates are likely to increase. So if we go back to the losses that we're incurring, and you'll probably, if you've got income protection benefits in place, you would have seen, I think, Matt's smiling because I think he's experiencing it as well. A couple of the insurers increased their IP premiums by up to 70% year on year. Yeah, all of them have increased bar one insurer in the last 12 months, and those averaging between 30 and 40%. They are still not at a profitable level. So my expectation is that once these new products have been started and commenced, and their premiums are actually in line with what the old premiums were from a rate perspective, I would expect anything that was pre-1 October is still going to experience premium increases over the next 2 or 3 years. As to what percentage, I don't know. All I can say is that if they're still in the red, APRA will penalise them if they haven't got a sustainable premium approach for that portfolio of policies as well. Yeah. So where it's going to affect your clients, and you'll see this when you're getting all of their information, etc., and it's going to become a big bugbear, is that they're going to get year-on-year premium increases, and some of them are just unsustainable. And at some point, a decision will need to be made. Do I want the better product, or am I happy to take a lower premium, knowing that I'll lose some of those benefits?
They're going to essentially price people out of the old products, and again,
100%.
particularly probably fair to say, James, that an older demographic will be even more aggressive, and because their risks there are significant.
Yeah, if we look back, probably about 10 years ago, we used to have what was called lifetime income protection benefits, where if you were disabled, they'd actually pay your benefit all the way through until you died. Now, those contracts obviously were not very favourable to the insurers, and they again had the similar thing of losses that were uncontrollable. The insurers removed those from the markets, and you've found over the next 5 years, those premiums actually quadrupled as a result. And it's a compounding thing. They put the premium rate up to make it more sustainable. The healthy people leave that pool of insurance policies and lives and take up the more lower cost policies, which leaves a pool of uninsurable lives, which are very much likely to have a higher claim experience, which then means higher insurance rates again, more increases. So one compounds the other, and you'll find over the next 5 years, I'm very confident those rates will go up quite significantly. I can see some further consolidation of the contract terms. So as I was going through, I was showing you there's quite some variances between all the different insurers. The reason for that is no one shared what their product was going to be. They all wanted to come out to market separately and hoping that they had the more competitive offering. I think in 12 months' time, they've had the opportunity to see what the market wants, what advisors are recommending, and I think that there will be some consolidation in those terms and conditions around replacement ratios and income calculations, etc. But over the next 12, 24 months, there's a very big piece or a role for the advisors to make sure that any product selection in that time is the most suitable for that client and ticking the majority of their boxes as well. And I think the last call out, and I'll leave with you on this one, is that insurance really is no longer set and forget. It used to be a case 10 years ago, 15 years ago, you buy a policy, you just keep that policy and you pay it for the next 10, 20 years and until you just didn't need it anymore. It's not the case anymore. With these rate increases, with these significant policy changes, I see more changes on the horizon for some of the other products, like your TPD products, etc. Actively managed insurance portfolios is something that is required. It's not something that an individual will be able to do by themselves either. If you come across any complexity, if you need any guidance in this space, obviously this is my area of speciality. More than happy to help out any of the Mazars clients or yourselves as an individual. Just reach out. if you want an idea of what's available, if you can get a copy of the client's renewal notice, send that through to ourselves. We can give some information or some opinion around whether it's compelling or whether there might be something else to consider as well.
And I think it's a excuse me, a really key point for our team that and in terms of how the Stanford Brown approaches is very, very similar to us, that if we do even have the slightest inquiry, guys, please ring James and give him a call. He's more than happy just to have a high level general conversation. The clock doesn't start counting there, just to kind of be able to help our clients. If something falls out the back and James can provide some advice to clients thereafter, great, but it's at no obligation to really help each other out kind of thing there. So we can then add some value to our clients and hopefully get them some better solutions.
Exactly. Perfect. I'm going to stop the recording there, but is there any last questions from the group around what's been presented or any thoughts around the income protection?
My only feedback is what I've seen, as you mentioned, the rate increases are just getting through the roof. It's just incredible. Yeah. They're trying to price everybody out of the market to get onto these new policies. Yeah,
exactly. And look, it's not just yourselves, it's your clients. And as you're meeting with them throughout the year and you know they've got these policies, start flagging it with them. I wouldn't want to wait and see too long because people's health changes as you get older. It gets harder to take out new cover as well. There's no better time than the present to start reviewing what's in place. And it could be just a recommendation to hold for the short term, or it could be a very strong recommendation to change. We talked about insurance consolidation there. The insurers are consolidating as well. I mean, the banks have moved out of the insurance market. BT is no longer owned by Westpac, and that's been purchased by Tau. Anyone with Westpac policies, CommonSure policies, a lot of these legacy policies, they're going to have even more compounding premium increases over time as well, and really should get some advice in that space. Perfect. Well, thank you, guys. I really appreciate the opportunity. I'm going to circulate this presentation around. Just hit stop recording.